Welcome to the Greener Way podcast, a show about people, planet, and purpose, and how investors and corporate leaders push forward in a complex world. I'm joined by Insight Investments Head of Responsible Research and environmental economist David McNeil to talk about the outlook for green bonds in 2023. But before we even get into that, David, I have to ask, what is an environmental economist, and how does your background shape your current role?
Yeah, thanks for having me. Well, essentially, environmental economics is looking at the risks or the impact of investments on climate change, on nature, on broader environmental, social, and governance measures. So I've had a range of different roles. My 10 years in the industry started out working with corporates, developing water stewardship schemes, then went into policy development for a number of years, then the data side of climate and ESG, so working with corporates on footprinting their carbon emissions for a number of years, then looking at the credit risks relating to climate change within a rating agency. So it can be quite diverse, and there's a range of skills I think that people are looking for in the industry as it matures.
Look, I have to say, it's one of the things that I love the most about being a reporter in this area is that you really do find people from diverse backgrounds. It's fantastic for broadening the mind. So that's great for that introduction. Can we start right at basics, David? What is a green bond, and how does Insight Investments look at green bonds as part of your wider portfolio decisions?
Yeah, certainly. So I think the one thing that tends to surprise lay people or people outside the financial sector is that there isn't a formal universal standard of what a green bond is. This can actually be a range of different instruments with different conditions tied to them. But at a basic level, a green bond specifies the proceeds of the bond should go to green projects rather than general corporate financing as a vanilla bond would. So in the early years of green bond issuance, this tended to be a bond issued where the use of proceeds was ring-fenced to renewable energy projects, energy efficiency measures in new buildings or retrofit, green transportation or electrification, or energy efficiency investments in industry. But as the market's matured, we've seen the range of projects that these instruments finance broadening over time. But we do still see a heavy tilt towards renewable energy in many cases. And many of those in the early years were self-labeled as green bonds by issuers. So typically this is corporates, but it could be banks. We see local or regional government, mortgage-backed securities, sovereign governments issuing green bonds. But in recent years, there's been a much stronger push for transparency and credibility of green bond issuers. So, for example, a company with a track record of breaching regulations on emissions to water, or in extreme cases, human rights abuses. These are points that would make investors typically wary of investing in green bonds from issuers with a weak ESG profile. And then you also had a question on Insight's view on green bonds. So we're really a long-term focused asset manager. Our focus is really on certainty of returns for our clients. So we view the low carbon transition as presenting risks and major opportunities from an investment perspective. Historically, there's been a focus, I think, particularly with regard to climate integration and investments on divestment, negative screening, really trying to screen out the worst performers. But divesting from the worst performers doesn't necessarily deliver real world emissions reductions if those companies are getting financing from elsewhere. And it also doesn't help address the systemic risks of climate change or the physical risks of climate change to the investments of our clients. So we think that channeling capital to effective and credible green bonds is really the key to reaching net zero. We see an increasing number of clients looking for funds with growing allocation to green bonds, or even pure impact strategies in some cases. But I think the thing to underline is that having a green label, again, is simply not enough. That introduces greenwashing risk. So for our sustainable fund ranges, we typically undertake an impact bond rating assessment. So this enables us to rate the framework of the bond for quality. So we'll have a detailed look at the use of proceeds, assess whether these are new projects or not just refinancing of existing projects. We'll look at the underlying ESG credentials of the issuer, going to the points that I mentioned, whether there's any external validation of this, so a second party opinion, for example, and then what detail there's likely to be and the frequency of impact reporting. So these strategies will typically have a target of at least 10% of the fund allocated to green bonds. On average,
Mm-hmm.
that can be 15 to 20%. And we also invest in sustainability linked and transition bonds. So we really see there's a lot of opportunity in the green bond space to finance the transition, to help our clients move towards net zero in a cost effective,
Mm-hmm.
opportunity focused
Mm-hmm.
strategy. But really, these need to be credible green bonds. We want to kind of mitigate the risk of greenwashing.
From your perspective, David, is there an actual greenium that's attached to green bonds or sustainability linked bonds or sort of transition bonds? Is it a matter of there's actually something in this for investors, either in reduced risk or increased return from a bond strategy, or is this mainly about being involved in the proper trajectory to align your portfolios with sort of the trajectory of containing climate change as close to 1.5 as possible?
Yeah, I mean, I think there's definitely been evidence of greenium in the past from the green bond market. Historically, it's a market that's seen undersupply relative to demand of green instruments. A
Mm-hmm.
lot of issuers historically would tell us that they would struggle to find a suitable range of projects
Mm-hmm.
to finance under a green bond structure despite strong investor demand. I think probably fair to say we've seen greenium erode over the last few years. But interesting, the European Central Bank, for example, has taken a detailed look at issuance over time, and they found that there's still a greenium associated with what they call credible issuers of green bonds. So
Mm-hmm.
issuers that have a strong ESG profile, that have detailed reporting commitments, that have second-party verification of these frameworks. So generally, I think the market is maturing a bit. There's much more of a differential there for the high quality frameworks.
Mm-hmm.
But what we're starting to see, I think, just because of that undersupply, strong demand dynamic, is there's a bit of a two-tier market emerging. So the top tier of the market, increasing competition for the high
Mm-hmm.
quality frameworks,
Mm-hmm.
with good issuer credentials, with strong external verification, etc. But
Mm-hmm.
then at the bottom end of the market, still very strong residual demand for maybe green bonds with weaker issuer profiles, with weaker frameworks. So it's interesting seeing that dynamic starting to emerge. And I think that will be something that will play out over the next few years.
Mm.
This kind of bifurcation of the market into high quality, high cost frameworks at the top end, low cost, lower quality frameworks at the bottom end.
Mm. It's really interesting, David. And look, I'm going to ask you later on in our conversation about what we can expect specifically for 2023. But before we get there, I
Mhm.
think it might be worth probing a little bit in on that. From your perspective, from Insight Investments' perspective, is it better to have a labeled ring fenced green bond that's attached to use of proceeds that are, where you can see that credibility and that transparency, but the overall issuer is maybe lagging a little bit overall? Or is it better to get a slightly less pure bond in terms of use of proceeds, but the overall company's quality is better? How do you weigh? And I know that Insight has a traffic light system
Mm.
on some of these issues, but how do you weigh purity ring fenced, poor quality overall issuer versus slightly better company, but slightly less ring fenced?
Yeah, so it's a bit of both in practice. I mean, I
Mm.
would say that the overall ESG strategy of the issuer is something that we look at within
Mm-hmm.
our impact bond assessment framework. So, if you were, say, a very high quality framework from an
Mm-hmm.
issuer that had historically underperformed
Mm-hmm.
on ESG or climate change, that is something that would be factored into the rating. And we have actually seen, downgrades of certain frameworks from dark green, our highest rating in terms of disclosure expectations, to light green in some cases, because we've seen controversies on climate change or ESG associated with the issuer.
Mm-hmm.
In practice, I'd say it's a bit of both. We
Mm-hmm.
have what we call impact issuers. So these
Mm-hmm.
are issuers that were holding bonds on the basis of their revenues or their
Mm-hmm.
capex and opex plans. So these could be issuers that maybe have a weaker ESG profile today, but we know are making capital investments and operational spending investments within their general investment plans for the next few years to try and improve, to try and demonstrate momentum on ESG.
Mm.
Um, so generally, it's a bit of both. I think it's quite interesting in the context of sustainability linked bonds. So these are bonds that are targeting general corporate investment needs,
Mm.
but typically tying this to a defined environmental KPI and then introducing penalties in terms of the coupon where they don't meet those targets. I think that's been obviously an asset class that's seen quite rapid growth over the last 3 years. In 2022, saw quite sharp decline. And I think a lot of that related to rising concerns amongst investors about the credibility of those frameworks, whether they introduce sufficient penalties to issuers for not meeting those targets.
Yeah.
Typically, that will be in the range of 25 basis points. In many cases, it's in the last 2-3 years of the bond maturity. So there's a question of whether, that is kind of introducing sufficient penalties on the issuer for not meeting the targets. So I think there's a bit more skepticism, a bit more caution around those instruments in general. And I think it kind of goes against the grain of what we're seeing in the wider sustainable finance industry of very much standardization, regulatory push towards crackdown on greenwashing or perception of greenwashing. And one of the benefits of sustainability-linked bonds is that these are highly bespoke. They have different structures for each issuer. So it does raise a bit of concern, typically amongst investors. I think also regulators, there tends to be restrictions on the holding of those bonds versus green bonds within, for example, bank capital requirements or under sustainable investment plans, holding those as green assets. There are a few more restrictions on SLBs.
So just to make sure I've got this straight for my audience, David, the difference between a green bond and a sustainability linked bond, as I understand it, is so the green bond is linked to underlying green assets. So there's a straight line on proceeds, whereas a sustainability bond is linked to corporate behavior, i.e. future commitments around net zero or,
exactly.
if it's wider gender diversity or targets like that.
Yeah, exactly.
Okay. Good to make sure that we're clear on these definitions. We can slip into this highly technical language far too quickly, can't we?
Yeah, absolutely.
Okay, so with all of that as sort of the analytical background, David, how strong and how deep is the international green bond market at the moment? And how does Australia fit in? I mean, you just referenced the fact that in 2022, there was a pullback in sustainability-linked bonds at a global level over greenwashing concerns, validity concerns. But how else does this fit? What is the outlook now for green bonds?
Yeah, so I'd say, there was a general decline in green, social, and sustainability bonds, including SLBs, including green bonds over 2022, but that kind of reflected the wider market backdrop. We did see the green bonds market in particular show quite a lot more resilience than the broader bond issuance universe. So I think there is still strong demand for these instruments. We are starting to see first signs of recovery. Certainly in the green bond market, a lot of issuers coming to market in Q1 so far, a lot more interest, I think, in issuance over the course of 2023. And we think a lot of that could be just down to stabilizing market conditions, but also resilient demand for these instruments. A lot of regulatory incentives for investors to start purchasing these instruments again. So the market's grown rapidly in the past 5 years from relatively niche area of finance to these bonds issuing or representing a major share of overall bond issuance. So S&P, for example, has projected that green social sustainability bonds could represent 15 to 20% of all new issuance in 2023.
That's a fairly significant chunk at a global level, isn't it?
Yeah. So starting from a very low base, but starting to represent a fairly large chunk, as you say, of the overall corporate bond issuance, but also in other asset classes, financial institutions, sovereigns, etc.
And then Australia specifically, we love our home country bias.
Yeah, so I think Australia's a really interesting case. Historically, been a very low share of the global green bond issuance market, but growing very rapidly. So energy transition, as everybody knows, presents major challenges to Australia's current export and industrial model. So there's been analysis by Net Zero Australia. It's estimated that to replace the value of total gas and coal exports with clean energy-focused exports, such as green hydrogen and renewable energy, investment would need to expand by as much as 15 times today's levels at a cost of hundreds of billions of dollars. So there is a need for these major long-term focused investments, particularly in renewable energy generation, but also electricity transmission infrastructure, development of hydrogen supply chains, and addressing some sensitivities to transition, particularly just transition, and making sure that communities are continuing to benefit in this transition. So this actually points to strong growth prospects for the domestic green bond market and to low carbon finance. And we think over time, these policy signals will add greater weight to investor momentum on decarbonisation. So even in 2022, issuance of Australian green bonds more than doubled on 2021. And Australian dollar denominated green or impact bonds currently represent around 1.5% of the global issuance. But we also see a growing volume of issuers in high impact sectors such as mining and energy, bringing these instruments to market locally. So there's a range of new issuers coming to market in Australia. I think the domestic market is starting to grow quite rapidly. And I think very bright prospects as a result of kind of policy support in particular.
I think so. Throwback for our listeners to episode 9, where we interviewed Christy Graham of the Australian Sustainable Finance Institute. The development of an Australian-specific taxonomy for sustainable finance, one can imagine seeing catalyzing green sustainability-linked and sort of impact bonds as well once there's a common language for it, I imagine.
Absolutely.
Yeah. Now, finally, getting to the outlook for this year, David, will we expect to see more labeled green bonds sort of at the global level? And how about this momentum that we've sort of hinted at earlier in the interview? More green bond issuance, but also maybe the vanilla market becoming greener as credit rating agencies, as banks, as issuers ask for, sustainability linked information as sort of table stakes for bond issuance.
Yeah, so I think some pretty interesting trends ahead for this year. We have seen, as I said, a recovery in the market, the green bond market in particular returning to momentum. One of the trends that we expect to see is a lot more issuance in emerging markets. So particularly that stabilization of interest rates over the coming months that we expect, encouraging a lot more emerging market issuers to bring bonds to market. And again, we think this links to the much stronger need for social and environmental investment in those emerging markets, desire amongst investors to demonstrate meaningful impact. So demonstrating that they are having a tangible effect on climate change in high need emerging markets. So that is one trend where I think we expect to see a lot more green bond issuance coming through. And also at the sovereign level, we've seen India issuing a sovereign green bond for the first time this year as well. We expect to see a lot more emerging markets bringing green bond structures to market.
It'll be interesting to see the first regulatory action on an issuer on greenwashing grounds. I think that's something probably we should all be staying tuned for this year.
Yes, absolutely.
David McNeil, Insight Investment, thank you so much for your time.
Thank you.
Thanks for listening to the Greener Way podcast. If you liked today's show, remember to rate and review us on your podcast platform and make sure you're subscribed so you don't miss an episode. Any feedback? Contact us on podcast@fssustainability.com.au. I'm Rachel Allen-Backus.
The Greener Way podcast is a product of FS Sustainability, a show about people, the planet, and investing in our collective future. All information in this podcast is for education and entertainment purposes only. The Greener Way podcast gives listeners access to information and educational content provided by discussing numerous financial sustainable options and our featured guests. It is not intended as a substitute for professional, legal, or tax advice. The hosts of The Greener Way are not financial professionals and are not aware of your personal financial circumstances. FS Sustainability operates under an Australian Financial Service License and the exemption made available under the Corporations Act 2001 in respect to any information or advice given. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. For more information, head to the disclaimer page on the FS Sustainability website, fssustainability.com.au.